Ladies and gentlemen, Asian Guy here, and the precious metals war we discussed yesterday has just escalated to levels that should concern anyone trying to understand global markets. What started as regional price differences has now become a complete breakdown of international market coordination that's spreading beyond precious metals into currency markets, trade relationships, and economic policy. This is the continuation of our educational series on precious metals market warfare, and today we need to examine what happens when market fragmentation reaches systemic proportions and begins affecting the broader global economy. Let me start with the latest developments that show this situation is accelerating rather than stabilizing. The $282 Chinese gold premium we discussed yesterday has now expanded to over $320 per ounce. That's not market volatility, that's a complete rejection of international price coordination mechanisms. Chinese buyers are essentially declaring that Western gold pricing is irrelevant to their market conditions. Silver has pushed through $95 to reach $98, while Shanghai silver is now trading at $115, a $17 spread that makes yesterday's premium look modest. The East-West silver divergence is widening despite every economic theory suggesting that arbitrage should be narrowing these gaps. But here's what makes this situation truly unprecedented. The divergence is now spreading beyond precious metals into base metals, energy commodities, and even currency relationships that affect global trade. The educational framework we need to understand is how market fragmentation in one sector can create cascading effects throughout interconnected global systems. When precious metals markets lose coordination, it signals underlying stress in the financial and logistical systems that support international trade. These systems include currency exchange mechanisms, trade finance availability, shipping and insurance markets, and regulatory frameworks that facilitate cross-border commerce. The breakdown we're observing suggests that one or more of these supporting systems is under sufficient stress to prevent normal market arbitrage from functioning. Understanding which systems are failing helps predict where the fragmentation might spread next. Let's examine the specific transmission mechanisms that are spreading precious metals market warfare into other sectors. Currency market stress appears to be amplifying rather than moderating precious metals divergences. Normally, when commodities trade at different prices in different regions, currency arbitrage helps coordinate pricing by allowing traders to exploit both commodity and currency differences simultaneously. The fact that precious metals divergences are widening despite currency arbitrage opportunities suggests that currency markets themselves are experiencing stress that prevents normal coordination mechanisms from working effectively. Trade finance availability represents another transmission mechanism. International commodity arbitrage requires financing to purchase, transport, and deliver physical goods between markets. When trade finance becomes expensive or unavailable, arbitrage becomes impossible, regardless of price differences. Recent reports from major banks suggest that trade finance availability has become increasingly constrained due to regulatory requirements, risk management concerns, and capital allocation priorities that favor other business lines over commodity trade financing. Shipping and logistics constraints provide physical barriers to arbitrage that financial solutions can't overcome. Even with available financing and favorable currency rates, physical commodities must be transported between markets to eliminate price differences. Global shipping capacity remains constrained by pandemic-related disruptions, labor shortages, and infrastructure bottlenecks that limit the physical movement of goods regardless of economic incentives to do so. Insurance and risk management considerations add another barrier to international arbitrage. Political tensions, trade policy uncertainty, and supply chain disruptions have made international commodity trading riskier and more expensive to insure. When insurance costs exceed potential arbitrage profits, traders stop attempting to coordinate international prices, even when significant price differences persist. The regulatory environment provides perhaps the most significant barrier to precious metals arbitrage. Export restrictions, import licensing requirements, and strategic material controls can completely prevent arbitrage regardless of price incentives. As more countries implement policies treating precious metals as strategic resources rather than commercial commodities, the regulatory barriers to international arbitrage continue to increase. Now let's examine how this precious metals market warfare is affecting broader economic relationships and policy decisions. Countries experiencing precious metals shortages at elevated prices face difficult choices about industrial competitiveness, strategic stockpiling, and trade relationships. When domestic manufacturers must pay $320 premiums for gold or $17 premiums for silver, their cost structures become uncompetitive with manufacturers in regions with better access to metals at international prices. This competitiveness gap can force governments to choose between accepting industrial disadvantage or implementing trade and currency policies to secure better access to strategic materials. The currency implications are particularly significant because precious metals have historically served as neutral stores of value that facilitate international trade and investment. When precious metals markets fragment along regional lines, it undermines their utility as neutral value storage and forces countries to develop alternative mechanisms for international commerce. Some countries are responding by increasing bilateral trade agreements that bypass traditional dollar-denominated commodity markets. Others are developing strategic partnerships with commodity-producing nations to secure direct access to raw materials. These policy responses further fragment global markets by creating exclusive trading relationships that prevent broader market arbitrage and price coordination. The monetary policy implications extend beyond individual countries to affect global financial stability. Central banks historically use gold and silver as reserve assets, partly because their values are determined by global markets rather than any single country's policies. When precious metals markets fragment regionally, central banks must choose which regional prices to use for reserve valuations. These choices can affect currency stability, international lending relationships, and financial system confidence. The investment and wealth management implications are equally significant. Institutional investors typically assume that commodity prices reflect global supply and demand conditions. When markets fragment regionally, this assumption breaks down and forces investors to develop new analytical frameworks for understanding commodity values. Pension funds, sovereign wealth funds, and other large institutional investors are finding that their commodity exposure behaves differently than their models predict because their investments trade in one regional market while their economic exposure comes from different regional conditions. The educational insight is understanding how market fragmentation creates feedback loops that amplify rather than resolve the original coordination breakdown. As precious metals markets fragment, participants lose confidence in global price coordination mechanisms. This loss of confidence encourages hoarding, strategic stockpiling, and bilateral trade arrangements that further reduce the volume of metal available for international arbitrage. Reduced arbitrage volume makes markets more fragmented, which further reduces confidence in global coordination, creating a self-reinforcing cycle that moves markets away from integration rather than toward it. The measurement and monitoring of systemic market fragmentation requires different analytical approaches than normal market analysis. Traditional price correlation analysis becomes less useful when markets are fragmenting because correlations naturally decrease during breakdown periods. Instead, analysts must focus on the underlying systems that support market coordination. Currency volatility patterns provide insights into whether financial system stress is contributing to market fragmentation. Unusual currency movements during commodity trading hours might indicate that currency markets are amplifying rather than moderating commodity price divergences. Trade finance availability indicators help assess whether financing constraints are preventing arbitrage. Bank lending surveys, trade credit costs, and commodity financing volumes provide insights into whether financial barriers are contributing to market fragmentation. Shipping and logistics data help determine whether physical constraints are preventing arbitrage. Container shipping costs, delivery times, and route availability indicate whether transportation barriers are maintaining regional price differences. Regulatory monitoring helps identify policy changes creating or worsening fragmentation. Export restrictions, import licensing changes, and strategic material classifications dramatically affect international arbitrage possibilities. The risk management implications affect any business assuming global coordination will continue functioning normally. Companies with international supply chains must consider regional price differences might persist, affecting cost structures permanently. Investors must consider portfolio diversification strategies based on historical correlations might not work if fragmentation spreads across asset classes and regions. Timeline considerations show fragmentation can persist when underlying coordination systems remain stressed. Historical episodes lasted months or years depending on stress severity. Resolution requires either restoring coordination systems or developing alternatives functioning despite continued stress. Current conditions suggest movement toward alternative mechanisms rather than restoration. This is Asian Guy, and the escalation from regional price differences to systemic fragmentation represents one of the most significant changes in global market structure we've observed in decades. The lessons extend beyond precious metals to understanding how interconnected systems can experience cascading failures, creating persistent rather than temporary dislocations. Whether this represents temporary disruption or permanent shift toward regionalized markets will depend on policy responses, system repairs, and alternative mechanism development over coming months.